welcome to another investment update. Today I'm here with Ayrton Oliver, who is our fixed income portfolio manager. We're going to talk about what happened in the markets in April. Good morning.
Morning.
So, Ayrton, part of your role is looking at macroeconomic trends and how they impact financial data. What happened in April?
So in April we had quite a volatile month in the markets, driven by macroeconomic data. To start with, we got higher than expected inflation globally, and so that put pressure on the view that we would be cutting rates later this year. So with higher inflation means we probably can't normalise interest rates just yet, so that put some pressure on the market, thinking we are a while away from that. We also got GDP growth, so GDP came out weaker across some of the countries, so that showed us we might have a yucky situation of stagflation. We've got stagnating economies, but inflation not coming back down. So that put some pressure on equities, and we fell around 4%, which was on the back of those kind of negative economic prints. But then later in the month, we got the Federal Reserve kind of not seeing as much worry about the inflation prints, more keen to keep going on with potentially lowering rates later this year, and so that gave the equity markets a bit of a boost back up. And then later in the month, we got US employment data was a bit softer, which meant we may be able to lower rates later this year, and so the market kind of did a bit of a round trip flip, and we rallied back.
Okay, and so looking closer at the US, what did that data show?
So in the US, that's where we got the higher than expected inflation to start with. So that popped back up from around 3.2 to 3.5%. So it's kind of going the wrong way when we're expecting it to go back into that range under 3%. So that gave the initial kind of risk-off move that inflation is not coming back down and the central bank won't be able to cut. Then followed by that, we got the GDP, which was at 1.6% when people expected it to be 2.5. So that slowing in growth was a bit of a worry that maybe the consumer is not able to spend and things are slowing regardless of inflation not coming down. And then lastly, we got employment data, and so the employment data was quite almost perfect for what people wanted to see. So the amount of jobs added to the US economy was lower than expected, but not terribly low. The unemployment rate went slightly up, which is taking some pressure off the labour market, and the percentage of wage gains went a little bit lower. So wage growth was slightly weaker than expected, which is taking off some pressure on wages, which will therefore take off pressure on inflation. And so all of this came through, and the Federal Reserve being a bit more relaxed on the outlook and potential for maybe normalising rates later this year.
So there's some good news in the US?
Yeah, good news driven by bad news.
And what about our neighbours over in Australia?
Yeah, so they also had stronger than expected inflation, which was, again, seems to be the theme of the worries going around that inflation isn't coming down as quickly as we had hoped. And this over there actually caused quite a big reaction in the rates market. So prior to the inflation print, the market was expecting the RBA to be able to cut rates this year, like most of the economies around the world. However, after the inflation print, the market went into pricing in a 50% chance of another hike from the RBA. So be quite at odds with what people were expecting. However, then yesterday the RBA came out and they did not hike, and they said that they probably will not be hiking, and they're willing to wait and just see how the data comes out.
Oh, good. And so will New Zealand be following a similar trend?
So in New Zealand's, we're kind of ahead of the curve, so we were some of the first hikes to be put through when inflation got a problem. So 2 years ago, we were one of the first central banks to hike rates. And so our economy is a little bit ahead of the curve on that front, but unfortunately it means we're also ahead of the curve on things slowing. So although our inflation number came in as expected, there was some bad parts to the details. So the non-tradables, which is the more domestic related inflation, which is things that we can kind of control locally, not like food and oil and things that we import, that was a little bit higher than expected. So that will be a worry for the RBNZ, like most of the rest of the world having inflation not coming down as fast as expected. But the rest of the things that are coming through in New Zealand are not that great. So we've got employment came out weaker than expected, so less jobs were added. Actually, jobs were lost, so it went lower. Unemployment rate went higher. And inside the details were quite yuck. So we had youth unemployment picking up quite a bit, so that's the 15 to 19-year-olds, not picking up in a good way because people are going back to work or going back to study or getting a new skill, in which case they'd come out of the participation rate. So if that happens to that extent, it's good. They're going to get further education, and it'll probably be a good thing for the economy over the long run. but the actual unemployment rate of when they're trying to get a job but they can't get one, that ticked up as well. So it's not the best for the economy. However, it's unfortunately necessary to get wage pressures down, which will bring inflation down, which is what the central bank needs to see. And if that does happen, then we can probably, hopefully, cut rates later this year.
So still quite a bit of work to go.
Yeah, so a bit of work to go, and you're also seeing that in sentiment surveys that we've got, so business confidence and consumer confidence, which kind of gets a gauge of how people are feeling in the economy, just keep going lower. And consumer sentiment is almost down, or consumer confidence is almost down at where the GFC levels were.
Right, and so what key event risks are coming up?
Yeah, so we've got more and more macroeconomic data that the market we focused on. So we've got inflation data out of Australia and the US coming in later this month, and we've also got the Reserve Bank of New Zealand with their announcement and forecasts for forward-looking inflation and for their rate path, or where they think the OCR will go, and that's at the end of this month. So those will be key in trying to gauge where rates will go, and that will drive where kind of economic sentiment and the equity markets will go.
Right. And to wrap all this up, what has all of this data meant for your fixed income wholesale fund here at Generate?
So given the fixed income fund is predominantly bonds, bond prices go down when interest rates go up. So over the last month, with interest rates going up on the back of that, probably not going to be able to cut as much on the back of inflation, that pushed bond prices down. So bond returns were negative over the month. However, it does mean that you can buy bonds at better yields now. So I think from now it's starting to look more attractive, especially if you've got the view that we will get inflation under control, economies are slowing and interest rates will be cut. It probably means interest rates are going lower, and that should mean bonds prices go up and you get better returns from bonds. The only problem inside that is there's different types of bonds. So you've got your government bonds and you've got your corporate credit bonds. Inside the corporate credit bonds, depending on which sector that company is working in or where they're exposed to. If they're exposed to things like consumer spending and consumers turning off their wallets or putting their wallets away and not spending, that could cause some issues for those companies. So you've got to be a bit more picky on what bonds you own.
Very good. Well, thank you so much for joining us, and thank you for watching.
Thank you.